Hello everyone, welcome to the Stock Trading Tutor channel. If you would like to create a free Demat account, click the link in the description and fill out your details. Now let's look at the Systematic Transfer Plan or STP. First of all, let's see what STP is. Systematic Transfer Plan or STP is an investment plan that allows investors to invest a lump sum amount in a particular mutual fund and regularly transfer a specific amount into another fund. For instance, the investor can choose to transfer a predefined amount from a debt fund to an equity fund or vice versa on a regular basis. For this to happen, the units from one fund are sold and the money is used to purchase units in the equity fund. Now, let's see how it works. Let's take an example to understand how STPs actually work in the market. Suppose there's a mutual fund investor who has currently invested rupees 2 lakh in a debt fund. He has his eye on a particular equity fund. However, due to the volatility in the market, he is afraid that the value of the equity fund may decrease after he invests in it. But if the equity fund's value starts to rise, he could lose out on a potentially good investment. Instead, by investing through an STP, he can gradually transfer a specific amount from his debt fund to equity fund over the span of a few months or years. This gradual transfer of money can minimize his risk in the equity fund and the equity market while helping him earn quality returns at the same time. Now let's look at the different types of STP. First is the fixed STP. The investor can take out a specific sum of money from one fund and transfer it to another in this type of STP, that is the fixed STP. The next type of STP is the capital appreciation STP. In this, the investor transfers only the profit portion of the fund from one investment to the other. Now let's look at the advantages of investing through the systematic transfer plan. First is safety. By investing only a portion of your funds at a time in equity, you can shield your investments from market swings. This way, the entire fund won't be exposed to the volatility in the market. Another benefit is high returns. The main purpose of investing in equity is to earn higher returns. The equity portion of the fund can help investors earn higher returns over the long term. At the same time, you can earn consistent returns from debt or liquid fund. The next advantage is portfolio rebalance. Systematic transfer plans help investors to rebalance their portfolios by transferring the investments from one fund to another. For instance, if the investor feels that the portfolio is heavy into equities, he can start an STP to switch funds back into debt or vice versa. Systematic transfer plan is a very useful strategy to mitigate risks in the market, but it is necessary to remember that it doesn't eliminate the possibility of losses in the market. At the same time, the minimization of risk exposure means that the investor could lose out on potential returns when the market performs exceedingly well. However, this strategy can be used to cap losses and increase portfolio returns in the long term. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you would like to create a free Demat account, click the link in the description and fill out your details.